with the individual taxation. So for individual income tax return, we file the form 1040. So here it is for the form 1040. How is it look like? So yesterday we discussed about the filing status, various filing status available to file this income tax return. So we discuss about these filing status. First is single, then married filing jointly, married filing separately, head of household, and qualifying surviving spouse. So I explained you all these terms and their condition when these are applicable. So summarizing it today, first is single. You can file as single when you are like unmarried or legally separated from your spouse and has no dependent. Then is married filing jointly. You can file as married filing jointly when you are married, and whether you are living or not living with your spouse but legally married, then you can file as married filing jointly or separately as per your choice. Next is qualifying surviving spouse. It is filed when a person spouse has died and he or she has not remarried up to 2 years and has some dependents with who is living with the taxpayer for the whole year, and taxpayer is providing more than 50% of their household support. Next is head of household. Status is filed when a person is like separated, is legally separated from his or her spouse, and he has some dependent, whether the dependent is child or parents or relative, then he can file as head of household. So today we will discuss about the income, various type of income that can be reported in form 1040. So as an individual, you have certain kinds of income. Mainly the income is categorized into four categories. First is ordinary income. That means the income you are getting from as an employee from somewhere or getting from any other sources. Next kind of income is portfolio income, which you received when you are uh, is portfolio income when you have certain kind of investment and you are receiving any kind of interest or dividend. Next is capital gain. Capital gain is when you are selling a capital property, then it is reported as capital gain. And last source of income is passive income, which is from passive sources like rent, royalties, income from flow through entities like partnership, escope, and trust. So first of all, we will discuss these types of income. So gross income include all kind of income. These include cash as well as non-cash receipt, legal as well as illegal income, and any accession to the wealth. Like all the income that can increase our taxpayer net worth. For example, compensation for services, like if you are working somewhere and getting some wages or salaries, commissions, fees, bonuses, then it is a gross income for you. Business income or professional income. Business income or professional income means if you are running a business or like running a firm, for example, your CPA firm. So what the income you are earning, that will be reported as business income. Gains from property sale. If you are selling any property and getting some gain, then it is also income for you. Interest, rent, royalties, dividend. Interest or dividend if you are investing somewhere or you have some stock. So, and you are getting some interest, or you have certain investment in a company and getting some rent or royalties, that is also a income for you. Alimony is only a source of only a income if the divorce is up to December 31, 2018. After December 31, 2018, that means from January 2019, it is not a income for you. Income from partnership or S corporation. So if you are getting any income from flow through entities, like you are a shareholder in any S corporation or a partner in a partnership, then your income from these kind of entities is also reported on your form 1040. Next is pension and annuities. So if you are getting any pension benefits or annuities, then it is also income. Prizes, awards, gambling winnings. So for any prizes you are earning or any gambling winnings, it is also reported. Debt forgiveness. So if you are getting rid of certain kind of debt, then it is also a income for you. So where these income is reported, all these income is reported in form 1040, but there are certain schedules along with form 1040 where these kind of incomes are reported. For example, compensation for services or wages, it is also shown in form W2. Business income we show in schedule C. Interest, rent, royalties, dividend. Interest and dividends we show in form schedule B. Rent and royalties, pass through income we show in form schedule E. Okay, and these certain items which are directly reported on the form 1040. So certain items or incomes are specifically excluded. For example, if you are getting any gift or any money in inheritance, that is excluded from your gross income. Life insurance proceeds. So if you are getting any proceed on the death of a person, like as a beneficiary, you are getting some proceed. So that is also excluded. Certain fringe benefit. So if you are working in a company and getting certain fringe benefit, some types of benefits are excluded. Municipal bond interests. So if you are have an investment in municipal bond and getting the interest from these bond, that is excluded. Qualified scholarships. Next is uh, these are the some items that are reported in form 1040 and included in your gross income as an individual, and these are items which are excluded. Any doubt from till here?
No.
Okay. Next topic is determination of amount of income. So how can we determine the amount from these income? So if the income is in the cash form, you can add your in your gross income when it is actually received or is constructively received. When means when it is available to a taxpayer, no matter it is like the taxpayer has physical possession of it or not, but if it is available, like if you are getting any check but has not submitted in bank, but that is still income for you. Next is property. So if you are getting any property, then the fair market value of property will be a income for you. For example, if you are getting any goods worth $3,000, then the fair market value of the goods will become the income for you. Next, services. So if you are getting any services, then fair market value of services will be a income for you. For example, if an accountant does $1,000 tax return for a lawyer in exchange for $1,000 legal services, so both $1,000 will be a income. for accountant as well as lawyer. So if you are getting any services, then the fair market value of services received will be a income for you. Stock or non-cash compensation. So if a taxpayer is getting certain stock or non-cash compensation in exchange for the services he is giving or in exchange of work he is doing, then these stock are also taxable at fair market value. Debt forgiveness, again, if certain kind of liability is cancelled, then amount of liability cancelled will be a income for you. Next is realization concept, realization and recognition of income. Realization means कि when a transaction or event actually occurs or change in taxpayer economic position or the amount can be measured with reasonable accuracy. For example, if you are buying any stock at a $10 and it increased to $15, means any kind of transaction or a event is happening and which is changing the taxpayer economic position. That means the taxpayer stock is increasing to $15 in value. So there is a real no realization until sold. Selling the stock for rupees $15, realization event occur and a gain of $5 will be there. Recognition of income means ki when you are recognizing your income on the tax return. So in generally, if we are realizing any gain, we include or we recognize that income, but there are certain exemptions, certain exclusions or deferrals that is more detailed in the TCP section. For example, installment sale. Installment sale means if you are selling some item and uh, getting its value in terms of installment, like if you are selling a item for rupees $10,000 and getting the payment in terms of $2,000 per year, then there is no need to recognize all the income in 1 year. We can only recognize the amount of gross profit that is applicable to that installment. uh, Similarly, like in exchanges means ki when you are selling a property and purchasing the same property from sorry, when you are exchanging certain kind of property, both will be similar to each other, then the gain you are getting from one property, you can defer that gain, means the gain is not recognized in the tax return and can be deferred to the future period. Involuntary conversion means ki if you are like holding a property and that property may be damaged or seized by government and you are getting some reimbursement in exchange for that property, and that reimbursement amount is more than the value of property, then that will be a gain for you. But if you are purchasing another property within certain time period, then that gain can be deferred to future tax period. So these all will become in your TCP section. Contribution to retirement plans, again, if you are like contributing to certain retirement plan, for example, IRA, Roth IRA, a traditional 401k. So your income can be deferred through this. Okay, any doubt till here?
No.
And others?
No, ma'am.
Okay. Next is timing of recognition. We have certain kind of method like cash method, accrual method, and sometimes hybrid method. So if a company is following, oh sorry, not company, if someone is following cash method, so income will be recognized when it is actually or constructively received. For example, if you are getting any like cash in hand, it will be recognized as your income. But or constructively received means if you are getting any check on December 30, but you have not you have not cleared it in bank, and you are clearing it in January too, but it will be a income for you in on December 30. Under accrual method, uh, income will be recognized when it is earned, regardless of the receipt. For example, December rent earned and due on December 31 will be an income for your current year. Whether you are receiving this rent in the next year, but it will be considered as income for your current year. Hybrid means when you are using a combination of both cash and accrual method. For example, sales on credit and expenses on payment. So you are recognizing your revenue when even you have a sale on credit, and your expenses you are recognizing when you have actually paid it. Next is constructive receipt doctrine, means income is recognized when it is credited to taxpayer's account and available without any restriction, means it is available to the taxpayer no matter it is physically received or not. Again, this concept is same. Okay, so here we discussed about the sources of income, and now the sources of income are explained here in detailed manner. First is salaries and wages. Salaries and wages means if you are working somewhere and getting some wages or salaries, then it will be an income for you. But there are certain things also come in these kind of income. Salaries and wages include all compensation for personal services, whether it is in cash or in non-cash form. For example, salaries and wages. Under salaries and wages, these are certain items which are included in gross income, means taxable to the taxpayer. First is salaries and wages itself, like if you are getting any monthly salary or weekly salary, it is a taxable income for you. Commissions and bonuses, so additional compensation if you are getting based on some sales or performance, then it is also an income. Fees, if you are getting any professional uh, fees or personal services fees, then it is also a source of income for you. Severance pay means if you are getting any payment on termination, then it is also an income for you. Retroactive or back pay, then it is also an income. Vacation pay or sick pay, like if you are getting uh, any payment on the leaves, like paid annual leaves, then it is also income. Non-cash compensation, so instead of cash, if you are receiving any non-cash compensation like goods, services, then it is also a income for you and is taxable. Any tips, gratuities, stock compensation, so if you are getting any stock instead of cash, in exchange for your services, or your if you're like employee in a company and you're getting the compensation in terms of stock, then it is also a taxable income for you. But the taxable amount will be depend whether it is a qualified stock or a non-qualified stock. It will be comes in detail in your TCP section. Next is reimbursement not under accountable plan. So if employee does not substantiate expenses like flat travel allowance, it is also an income for you. Also, like if you are getting any reimbursement, like you're changing your place of working. So moving expenses is also a reimbursement. and is taxable to the taxpayer. So if your employer is paying you the reimbursement amount, it will be a taxable income for you. Exemption is if you are working in like army, then it will be a non-taxable for you. Otherwise, all the reimbursement expenses are also a taxable income. Employee award, so if you are getting any award like cash award for performance, then it will be a taxable unless excluded under the 74C qualified plan award. Forgiven employee loan, so if your employer is forgiving any loan, then it is also a taxable income for you. So under salaries and gross section, which are excluded, for example, de minimis fringe benefits. So like if you are using any items in a company, for example, if you are using a company's stationery, company's car, so it like small benefit, then it will be a non-taxable for you. No additional cost services offered to employees in employer's line of business with no substantial additional cost. For example, free standby flight for airline staff. So no additional cost services if you are getting, then it will be a non-taxable income for you. Qualified employee discount. So for example, if you are working in a grocery store and purchasing like goods and services from there, and as a employee, you are getting certain discount. So that discount, if it is up to 20%, then that will be a non-taxable for you. Working condition fringe item deductible if employee paid personally, for example, company car for business use. Qualified transportation benefit, if you are getting any transportation benefit, then it will be non-taxable to you. Employer provided meal, so if a meal is provided in a company, then it will be a non-taxable income. Employer providing logging, so if you are getting any logging for employer convenience is a condition of employment, so it will be a non-taxable for you. Group term life insurance, so if your employer is giving you any life insurance, so if the coverage is up to $50,000, then it will be a non-taxable income for you. But if it is above $50,000, then it will be taxable. Next is employer's retirement plan contribution. So if the employer is contributing to any retirement plan on behalf of you, then it will be non-taxable when it is like contributing, but when you are getting the benefit, then it will be taxable. Again, health insurance also is excluded from the income. Cafeteria plan, so if employer may choose non-taxable benefit like health coverage or FSA without any exclusion. Dependent care assistance, for example, if you are getting any dependent care benefit from your company, then up to $5,000 they can be excluded from your income. Educational, so if you are getting any educational expenses reimbursement up to 5,000 $250, it will be excluded. Moving expenses, again, if you are getting any moving expenses reimbursement, it will be a taxable amount. But if you are a army work, like if you are in army, then it will be a non-taxable benefit for you. So these kind of incomes that are reported in form W2, salaries and wages, and in under these certain are non-taxable. For example, these we discussed: any discount, any life insurance, any retirement plan contribution. Certain items are excluded from gross income. Okay, then next topic is related to stock-based compensation. So if you are getting any stock in terms of compensation, so that will be taxable depending upon whether it is a qualified stock or a non-qualified stock. So if it is a non-qualified stock, it will be taxable when you are exercising it. But if it is a qualified stock, for example, you are getting any incentive stock option, then it will be not taxable at exercise. But if you sell this stock in future, then it will be taxable at the time of sale. Okay, any doubt till here?
No, ma'am. No, ma'am.
Okay. This is some like examples are given. For example, employer pays $12,000 towards employee health insurance. So if the employer is paying or contributing to your health insurance plan, then it will be excluded from your gross income. Next is if you're getting any mail from company, then it will be a non-taxable income for you. These are we already discussed. These just for reference, these examples are given. Cash award for best employee of the month. So if you are getting any cash award, it will be taxable unless the qualified plan award. Next, discount. So discount of 30% on employers' retail goods where gross margin is 40%. So if the gross margin is 40% and you're getting 30% of discount, then 10% excess will be taxable. Company car used 70% business and 30% personal. So if you are using a company car for personal use, then 30% of fair market value taxable as the fringe income. Life insurance coverage, again, it is greater than $50,000, then the additional amount, that is $100,000, will be the taxable income for you. Education reimbursement, so up to 5,000 to $50, it is excluded, and excess of it will be a taxable income for you. So again, it is given. Uh, these slides are same as previous.
Are you sharing slides?
You are not able to see the screen.
No.
So okay. I am teaching from the slides. I was teaching from the slides from the half an hour.
I mean, I didn't know that, so that's why I asked you now.
Okay.
Garima, we could hear you. Right.
But what I was like teaching from the slides. Uh, it's visible now.
Yes.
Okay.
Yes, now it's
So are you able to understand just from listening? because I was teaching from these slides. Okay. So I think sir has shared these slides in group.
Yeah, it was in the group. Yeah.
Okay. So I started with these gross income items, wh- which items are like included and which are excluded. Then I explain you about the amount of income when it is how is the amount of income recognized, like when it is in cash or property or a services, stock compensation, debt forgiveness. Next, I explained about realization concept. Means realization is when our recognition of income is when. Should I like repeat or move ahead?
I think it's fine. You can move ahead.
Okay. Then I explained you about timing of recognition when it is cash or approval method. Income is recognized. How? Next, we discuss about salaries and wages part. Okay, under salaries and wages, we have items that are included in gross income and certain items which are excluded from gross income. Okay, so next is fringe benefits. So after salaries and wages portion, there is some fringe benefit also, sometime for employee, sorry, which are provided by the employer. Means that a form of pay other than the money for the services. So in 1040 form, certain fringe benefits are taxable and certain are non-taxable. For example, a list of non-taxable fringe benefits like no additional cost services. So if you are in same line of business and you're getting some cost, then it will be a non-taxable. For example, if you are a like air hostess or a staff in airline and you're getting a free flight ticket, then it will be a non-taxable income for you, non-taxable fringe benefit for you. Qualified employee discount, we already discussed ki if the employees are getting certain kind of discount on items which are sold by their employers, then that discount, if it is up to 20%, then it will be a non-taxable income for them. Working condition frame means if the product and services would be deductible as business expense if employee paid personally. So if an employee is paying for certain item and that is used in business, then it will be a business expense. De minimis fringe benefit, like fringe benefit which are very in small value. For example, you are using a company's like stationery or coffee, meals, then it will be a non-taxable income for you. Qualified transportation expenses. So if you are getting any like transportation expenses, transportation benefits, then it will be excluded up to $3,315 per month. Qualified moving expenses. So if you are getting any moving expenses reimbursement, then it will be taxable for you. But if you are an active duty military member, then it will be a non-taxable income for you. Qualified retirement planning services, again, If the employer pays for employees' retirement counseling, it will be a non-taxable income for him. Qualified on-premises athletic facilities, it will be a non-taxable. Also, others item which are also non-taxable, like any health insurance, accident and benefit plan, group term life insurance, educational assistance program, dependent care assistant, but certain limitations are also applicable. Meals and lodging, cafeteria plan, adoption assistance, de minimis cell phone use, adoption assistance. So these are items which are also non-taxable to the employees, but some items are subject to certain kind of limits. Okay, these are certain examples given on these notes. Free standby flight for airline employee. Again, if the employer and the benefit are like same line of comes under same line of business, then it will be a non-taxable. 30% discount or 40% gross margin. So it will be a non-taxable income. Free bus passes. So since limit was $315, it is less than the threshold, then it will be a non-taxable. If the employer paid health insurance, again, health insurance premium is a non-taxable benefit. Employer gift rupees 500 cash for holidays. So it will be a taxable because it is not the like minimum amount. Occasional office party or free coffee, it will be a de minimis benefit, then it will be a non-taxable. Again, company gym qualified facility, it will be a non-taxable. Lifetime time insure lifetime insurance, $100,000. It is like more than the threshold, so it will be a taxable. Tuition reimbursement of $6,000, so our limit is $5,250. So since it is greater than the threshold, then it will be a taxable. Again, no additional cost services, it will be excluded. Employee discount, working condition fringe, de minimis fringe, transportation fringe, it will be excluded. Okay, so all these incomes will be reported in your form W2, and under these like salaries and wages and fringe benefits, certain items are taxable and certain are non-taxable. And some are subject to some like limits ki up to that they are not taxable, and above that it will be taxable. Next type of income is the interest income. Interest income means the income the interest you are receiving from any investment. So first of all, interest income is reported in your schedule B, and certain kind of interest are taxable or certain are non-taxable. Okay, so these are common types of taxable interest income. So if you are getting any interest from your savings and bank deposit, corporate bond, US Treasury bills, notes, bonds, private mortgage or personal loans, installment sale interest, US saving bonds, late payment interest or imputed interest. So these kinds of interest incomes are taxable. Whereas if you are getting any interest income from municipal bond interest or US saving bond interest, It will be excluded if bond proceeds are used for qualified higher education expenses. So US saving bonds, interest from US saving bond, it will depend ki where you are using these proceeds. So if you are using for qualified higher education expenses, then it will be a non-taxable income for you. But if you are not using uh, in qualified education expenses, then it will be a taxable income for you. Okay. Series EE bonds, minor child ownership, interest on certain V or FHA dividends. So these will be excluded from your gross income. Mainly in interest part, you need to consider municipal bond interest. It is non-taxable, and taxable is corporate bonds, any US Treasury bills, notes, bonds from any federal or local level, then it will be a taxable. If it is at federal level, it will be taxable, and if it from state and local bonds, then it will be a non-taxable income for you. These are not important. Okay, any doubt?
No, ma'am.
Okay. Prepaid interest. So in case of interest, if we have prepaid it, then it will be not deductible. Like, it will be only deductible which is applicable to the period it applies to. We can't deduct the prepaid amount in the year we actually paid, but for the prepaid interest, we will deduct the amount that is applicable to that period only. For tax exempt interest reporting, like for example, interest from municipal bond or certain state and local bonds, then it will be not included in your gross income. But if you are calculating alternative minimum taxes or social security benefit taxation, then it will be used there because it affects them. Next is forfeited interest. The interest the taxpayer is loses or gives up, usually when a time deposit or certificate of deposit is withdrawn before maturity. Banks commonly imposes a penalty when a deposit redeemed as CD early. Treatment in tax computation. So, for the forfeited interest which is actually earned is included in the gross income, whereas interest that is forfeited means there is certain kind of penalty on early withdrawal that you can deduct under the deduction for the AGI section. It will comes when we studied about adjusted gross income. Okay. So in Schedule B, we also show the dividend part. So under dividend, generally all the dividend you are receiving are taxable, but certain special tax rate is applicable if the dividends are qualified dividends. So they are taxed at preferential tax rate. Capital gain dividend, they are taxed as long-term capital gain, and return of capital, if you are getting like any return of capital, then it will be a non-taxable for you. Again, when it is a liquidating dividend, that means it is a capital gain for you and is taxable. If you are getting any return of capital, uh, means your stock basis is reduced up to that amount, it will be non-taxable. If you are getting any stock dividend, that will also be non-taxable. But if there is an option to like purchase cash dividend, then it will be a taxable income for you. Property dividend, it will be taxable at the fair market value. So if you are getting the dividend and it is out of current earning and profits, it will be fully taxable dividend. If you are getting any dividend out of accumulated earning and profit, then it will also be taxable. But if you are getting the dividend above these amount, that means there is return of capital, then it will reduce your stock basis and will be non-taxable income for you. And if you are getting the amount or distribution above your stock basis, then it will be taxable as a capital gain. It will comes in more detail in TCP section. Here in REG, you only need to remember what kind of dividends are taxable and what are not. For example, if your stock basis is $10,000 and you are getting a dividend of $12,000 and your earning and profit is $8,000. So up to the amount of earning and profit, it will be a taxable dividend. Next, up to the amount of your stock basis, it will be a return of capital. If you get the dividend above your stock basis, then it will taxable as capital gain. Now comes the qualified dividend. Qualified dividends are generally the dividend which we held for 121 day period, and they are taxed at the preferential tax rate. Preferential tax rate are the tax rate which are applicable to the capital gains. These are 0%, 15%, 20%. So condition for qualified dividend that it should be paid by a US corporation or a qualified foreign corporation. And holding period should be 121 days and it should start from 60 days before the ex-dividend date and held for more than 60 days. For preferred stock dividend, period should be more than 90 days during the 181-day period. Again, stock dividend, if you are getting, then it will be a non-taxable. But if there is an option to get cash dividend instead, then it will be a taxable part for you. For property dividend, it will be taxable at fair market value. And if it is a constructive dividend, then it will be taxable as the dividend. If you are getting any dividend from insurance companies, then it will be treated as rebate or reduction of cost and not included in income unless they are exceeding the premium paid. So if you are getting any insurance from dividend from insurance company, then up to the amount of premium it will be a non-taxable, but if it is more than your premium, then it will be a taxable dividend for you. Interest and dividend are shown in form 1099 along with schedule B. Okay, so this is the example given, calculation related to stock basis and like earnings and profits and distribution. Okay, any doubt till here?
No, Garima.
Okay, uh, then I'm stopping here, and tomorrow we will continue from here.
Okay. Thank you.
Okay, thank you. Bye.
Bye.
Thank you, ma'am. Bye.
Bye.